This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000.
Jeremy Grantham started one of the very first index funds in the world back in the 1970s. Since then, he has gained prominence within the financial community for his ability to read and predict the market with surprising accuracy. His firm, Grantham, Mayo, and Von Otterloo, oversees more than $65 billion of investments for its clients. Roughly a year ago, Jeremy was on Bloomberg being interviewed about the state of the financial market. He confidently predicted that a super bubble was on the verge of popping, with serious consequences headed our way. Have you been cautiously eyeing the major stock indexes for the past year or two? You aren't alone. The volatility and the unpredictableness of the market are at an all-time high. Growth stocks act like value stocks and vice versa. Inflation looks like a runaway train, and the Federal Reserve is taking drastic measures to control it. Jeremy Grantham is going to explain these patterns and signs in the following clip. He returned to Bloomberg recently to revisit his claim of a super bubble and the impending crash. With the market beginning to show the telltale signs, he backed his previous prediction with more fervor than ever. The United States and other countries have experienced major bubbles in the past. Some that may come to mind are the dot-com crash of 2000 or the major mortgage financial crisis of 2008. Even as far back as 1637, during the famed Tulip Mania, financial bubbles have been building, popping, and plunging entire nations into the deep end. During times like these, it's important to take note from the most knowledgeable investors and analysts. In this clip, Jeremy discusses the warning signals he sees, the S&P low that we should expect, the speed at which this bubble could pop, and much more. Should you sell? Should you buy the dip? Should you short particular stocks? He covers it all in this latest interview.
Jeremy, a year ago, you predicted an epic collapse in stock prices, and you told me it would rival the 1929 crash and the dot-com bust of 2000-2001. Were you wrong?
No, I don't think so. I noticed reviewing it last night that there was one little element of contradiction. At one stage I said, you can't call these events to within a few months. And at another point I said, history says that when you reach this level of craziness, the market tends to break within a few months rather than a few years. And I think with hindsight, the market started to get distinctly weaker about 10 months after we talked. So that's a few months plus a little bit.
All the same, 2021 was a great year for stocks. If I'm not mistaken, the 7th best in a half century.
And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85%. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1001 to 3000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic.
It's a pattern.
It's a pattern. It's a very rare pattern. And we have been checking off this list all year. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much more so even than NASDAQ.
At the risk of putting words in your mouth, you are as certain as you were then, if not more?
I would say clearly more. I did freely admit, not in our conversation, but elsewhere, that I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007. I used to think then in terms of near certainties. This time I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain now.
The hallmark of a bubble is what you have termed crazy behavior. What would you point to today, right now, as further evidence of crazy behavior?
I think the crazy behavior, the peak of crazy behavior is behind us. I really do. I think we're now in the buy the dip mode, which the super bubbles specialize in. You don't have 2 years of buying frenzy dying overnight, typically. So even in 1929, you had some magnificent rallies. And buy the dip is the watchword of practically every brokerage house out there. And it always is. You never, almost never, have a major brokerage house say, the game's over, guys, duck. It doesn't happen. The commercial imperative is overwhelming to stay bullish. It's how you make money.
If you're right, and stocks are in a multi-sigma deviation from the statistical trend, tell me what happens. The S&P 500 peaked at almost 4,800 points. Where does it bottom?
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
So we're talking about a decline of, certainly from the peak, of almost 50%.
Almost 50%. And of course it declined very quickly 50% in 1929. It declined 50% in 3 years in 2000. And the housing market, which was another great American super bubble, went all the way back to trend in 3 years.
Jeremy, it's one thing to predict a collapse in stock prices. It's another altogether to tell investors they should sell. Should they?
As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest. It's also true that the value end of the spectrum, as opposed to the growth end, is about as cheap as it gets. So if you can combine those by buying value stocks outside the US, I would say particularly emerging markets, but there's quite a few countries, Japan, the UK, where the markets are, if they're overpriced, they're only moderately overpriced. The US is not moderately overpriced. It is shockingly overpriced.
You and I have talked about the perils of shorting single name stocks. It's dangerous business. But given where things are and your level of certainty, would you short an index? Would you short tech stocks? Would you short the S&P 500?
Personally, as opposed to GMO, in the foundation we have for the protection of the environment, we are indeed short a decent amount of Russell 2000s. So we haven't been hurt in the last year, which is amazing. We're also short about half as much again as in the NASDAQ, which did hurt us, but not sensationally. And the point there is a lot of our money is in venture capital. That's very growthy. We need some hedging. And if we weren't exposed to a large amount of growth stocks, I suspect we would skip the hedging. We would skip going short. In any case, I would never short an individual name. I would only short a broad index. And the indices I would short, if I was up for that, would be the Russell 2000, because they have a high density of flaky companies that aren't making any money, and the NASDAQ, which also has a high percentage of companies not making any earnings at all. What makes the NASDAQ more complicated is that it has these remarkable FANG stocks in it. And that makes life complicated.
Jeremy Grantham is doing his duty by warning the world of an incoming crash made by our super bubble. Whether you believe him or not, the market signs are worth paying attention to. By staying in tune with the market, you can make the correct moves and protect your wealth. Thanks for tuning back into Profit Protection. If you enjoyed this video, leave us a like and subscribe to the channel so we can continue producing high quality content for you. If you want to learn how to profit from an upcoming market crash, check out our recent video on Peter Lynch's advice on doing just that. See you next time.